All right. Welcome to our last installment of the five-part series webinar, Navigating the Pandemic Through the Private Equity Lens, Independent Sponsors. My name is Ilian Overgon. I am the president of ACG South Florida and corporate banker at HSBC. ACG continues to provide the community with unique access to content and unparalleled networking opportunities throughout these difficult times. We engage our members by offering access to deal makers and business leaders. There's no better time to become a member as the organization continues to develop relevant programming to keep our community informed and connected. Join now and take advantage of the benefits that are being offered only to members. In addition, ACG South Florida is decided to launch our podcast available on iTunes. Subscribe now and listen as we interview local deal makers in the community. Thank you. Now let's get started. I would like to introduce you to today's moderator, Lily Slanway from Accord Financial. Lily, the floor is yours.
Thank you, Ilian. Good afternoon, everyone. My name is Lily Slanway, and I am the Senior Vice President of Accord Financial. We are a 43-year-old asset-based lender. We do a lot of transaction with the independent sponsor in the last 15 years. We love this business model, and we've made a lot of friends throughout the country, and we look forward to be making more new friends. It's my honor to moderate this panel, and I will say that we are in for a treat. With us today are highly experienced private equity professionals who have carved out their time from their busy schedule so they can share knowledge on the subject of how the pandemic has and is impacting the independent sponsor access to capital. So thank you, gentlemen. Appreciate it. We'll be approaching this topic in three different perspectives. From the perspective of the debt, of the equity, from the debt, and from the independent sponsor. On the equity side, we have for us, a senior partner from Centerfield, who does a lot of work in the independent sponsor, and Derek, founder of Boyne Capital, who for 13 years operated as an independent sponsor, and he raised his first fund several years ago. So he is going to be able to give us perspective from both sides of the equation. From the debt side is Tom from Convest, and then from a partner from Convest, and from the independent sponsor we have Grant, managing partner from NCK Capital. So we're really in for the treat, and during this webinar, just really quick, we'll be posting a survey, and we would love to hear your voice. The louder the voice is, the better off for all of us, and more meaningful. And then we will be posting the result of the poll at some point during the webinar. It'll be open, and then you can vote. And then later on, we're going to close the poll, and then we'll project the results. So let's get started. Gentlemen, how about we go ahead and start with your self-introduction, and we'll start with Ross.
Sure, thank you, Lily. So just as a quick introduction, Centerfield Capital has been around for 20 years, currently deploying Fund 4, which is a $335 million fund. We, as Lily's mentioned earlier, we are focused on two aspects of the investment community. One is the independent sponsor community, and the other is the funded sponsor community. So roughly half our deals are with independent sponsors and management buyouts, where we are the only or one of two institutional capital providers coming into the deals. And on the other hand, where in those particular deals, we provide essentially most of the institutional capital in terms of sub-debt and equity. On the other hand, we also invest alongside funded sponsors, where we are mostly lenders, and then we take a sliver of the equity depending on what the appetite of the funded sponsor is to provide in terms of equity to Centerfield. As I mentioned, we are currently on Fund 4, which is a $335 million fund. Typically, we invest 10 to 20 million in a deal in a wide variety of structures. We can put up to 50% of our capital in debt and 50% in equity. So thank you, ladies, for having me on the panel.
How about Derek next?
Sure. Pleasure to be here today. Derek McDowell, founder of Boyne Capital. We're a Miami-based private equity firm. As Lily's indicated, I started Boyne in 2006 as an independent sponsor. And we raised our first institutional fund in 2017, and we're in the process of raising a second fund. We hopefully be happy to talk about the independent sponsor experience going through the last recession and implications that may have for their funding and where we see that going.
Tom?
Hi, Tom Goyla with Comvest. Comvest is a private debt and private equity firm based in West Palm Beach. We focus on the middle market. We make investments in loans as small as 15 million and as large as 200 million plus. And we're very active in this market. From a lending perspective on our lending business, the majority of what we do is either independent sponsor or founder-owned businesses. We work with private equity firms as well, but that's a minority of what we do. So I'm excited to be here today. Thank you.
Okay, thank you. Grant?
Hi, my name is Grant Kornman. I'm the co-founder of NCK Capital. We're a private equity firm based in Dallas, Texas, and we operate as an independent sponsor. We have 5 portfolio companies today that we manage. We've acquired 3 of those in the last 20 months. So we're, think of ourselves as a pretty active independent sponsor. We focus on lower middle market companies with $2 to $10 million of EBITDA. And we love businesses that are niche manufacturers, value-added distributors, service-based businesses, or anything in the for-profit education world. We all think we're snowflakes in the world, but if we were going to differentiate ourselves, it's probably because we have a strong focus on operations. My partner and I have founded several companies and built them successfully, and try to bring that perspective to our investments.
Thank you, Grant. So let's get started. I thought the best way to do this is quickly set the stage and look at it from the 4 different perspectives from all of you. Talk about what are you seeing lately in deal flow, deal quality, how crowded is the bidding room, and the valuation trend. Is it going up, down, stays the same? So how about we start with the capital provider for us, and then Derek, and then Tom, and then Grant.
Sure. So from Centerfield's perspective, deal flow was really soft in March and April, and things have, and we frankly, most of us, including Centerfield, were in the market saying we are open for business, but I honestly don't know what that meant then, right? So deals were not getting, not as many deals were getting closed. So fast forward to today, starting in May and June, deal flow has been very robust. I would say it's probably back to, it's not the highest level, but it's clearly not at the lowest level either. So it's back to kind of the average deal flow we see every week on Monday. Our business is pretty lumpy in nature, so some weeks are busier than others in terms of new deals. So we had 2 deals signed up with independent sponsors before COVID happened, which were in February. We put them on hold, and then both those deals are back where we are evaluating the deals. The exclusivity has been extended, and then hopefully one should close next week and the other one shortly thereafter. So we're in the due diligence process. In terms of valuations, there are 2, in my opinion, I think there are 2 different worlds out there. Half the people know there's COVID happening. The other universe is really going along with the same plans. Purchase price multiples are still robust. Leverage is still high. Pricing is still low. And the other half of the universe is saying, well, let's take a pause and evaluate what COVID has done to these businesses, and let's rethink how to value these businesses and how to put what kind of capital structure to put in.
Derek?
Yeah, so I would agree with a lot of what Faraz said. You've seen a real slowdown in sort of call it the March, April, May timeframe of activity. We closed our last platform investment on March 17th. We completed an add-on in April, and we just recently, about a week ago, completed another financing transaction in the sale-leaseback market. So things are still getting done, but I would say it's really broadened into the haves and have-nots. There are lots of deals we saw that were shaky due to COVID that have just sort of dried up. And I think the bar for quality performance, especially on the ability to get the top half of the balance sheet, has changed. We have 3 companies under letter of intent that we're working on that we think are performing well in this environment and will continue to should perform well. That's why we're moving forward on them. But I think it'll take longer to get to close, just as people will continue to want to see their card turned over, whether it's from the diligence side or financing side. And I think until you get later in the year, things won't necessarily return to normal where they were in 2019.
Tom?
Yeah, deal flow has definitely picked up in May. I agree with Faraz that in March and April it had died off rather dramatically. Deal flow has picked up recently. We've been fortunate. We've closed a handful of deals, a couple of new commitments to existing borrowers, and several new loans as well. So we're fortunate that we have a lot of dry capital and a lot of dry powder looking to put it to work. The deals that we're seeing, I characterize it as a barbell. On one hand, we see quite a bit of distressed opportunities. And on the other hand, we see very high quality businesses that are not really affected by the coronavirus. Software deal, insurance deal, some of those types of businesses. And not much in the middle in terms of regular way. We're just starting to see some of those more regular way businesses coming out. We've seen a couple things on the healthcare side that have had some level of coronavirus impact, but I think people generally feel that those businesses will come back. So that's, I think, as time moves on, I think we'll see more of those businesses that are coming out. In terms of a crowded bidding process on the lending side, there's an awful lot of folks that are frozen that just don't have the ability to put money to work. If you have a leverage facility line, you may be taking marks in your portfolio and you're having to deal with that, and you can't necessarily put new money to work. So from that perspective, there's clearly fewer lenders, but there's fewer deals. So on the deals that are out there, my colleague said, there's probably 75% of lenders might be frozen right now, but there's 95% fewer deals. So it's still, somewhat competitive on the deals that are out there. And so that's something that's changing. On the valuation, it's really the same thing as well. Very high quality companies, the valuations are not suffering that much. So it'll be interesting to watch and see how that changes over the coming months and quarters.
Right.
Sure. I actually looked up our deal flow stats prior to this panel because I was curious if my feelings were the same as my facts, and I was actually pretty surprised. From a volume standpoint, we really didn't see much of a dip in March, April, or May. I felt like our deal flow has been much better in June in terms of volume, but it's been consistent with the prior months. I think what's changed has really been the quality. I think there's more actionable opportunities in the marketplace over the last few weeks than during the heart of the shelter-in-place orders. In terms of, are they more? Do things feel more competitive? I think all of the folks here who deploy capital for a living, we all hope for a day where it's more of a buyer's market, but it's been a long time since it's been that way, and I feel like it's just a product of where the market has gotten to. Things will always be competitive regardless of the macroeconomic cycles. I do think we're going to see an uptick in deal flow here in August and September as companies who have strong Q2s then come to market, and there's a little bit more level playing field in the debt markets. And I think in Q4, we're going to see the rise of the EBITDAC adjustment. When businesses that have recovered but had a tough Q2, I think the bankers are going to be positioning them based on an adjustment for the pandemic.
Great, thank you. So let's
Lilis,
yeah.
One thing I would add, just listening to the comments here, I think there's two kinds of deal flows happening, right? One are, seems like most of the people in this group in this panel are busy and deal flow is happening. I think the reason could be that these are all recognized funds who've been around for many, many, many years, and typically on fund 5, 6, or with in Derek's case, ran an independent sponsor model for a long time. So I think established funds are seeing a lot of deal flow. I'm not so sure where BD, business development is clearly much less, right? ACG conferences are not happening, AMAA shut down, SBIA. I mean, those kind of things are not happening. So I think the first and second time funds are probably seeing a lull, more of a lull than the group on this panel, at least, would be my best guess.
So there is a question here on this topic. It says, can you comment if there is a differences in sectors, specifically tech and business services? Can anyone comment about that?
I'll comment. One of the deals that we closed is in software. So from a tech perspective, and we've seen some other opportunities in the software sector. Depending on what the end market is, may or may not be affected. But so that's an area that we've clearly seen some activity, that is continuing to happen in M&A as well.
Great, thank you. So let's get to the heart of the discussion. Here is the question I put together, and I think we should approach this from the capital providers, and that would be Faraz, Derek, and Tom. And the question is, in the current situation, when an independent sponsor comes to you seeking for capital to support for a potential acquisition, what are some of the key drivers that you need to see in the deal? And what advice can you provide to the independent sponsor to think about before approaching the capital providers? So it's really two parts of section. What do you need to see, and what do you suggest them to do before approaching?
Here, let me. I'll kick off and give a view on that. I think we're starting to see, and having been an independent sponsor and done 9 platforms through the last downturn, I think you're starting to see independent sponsors realize the value of the stability and continuity of their investors. I know when I was doing deals in, call it 08, 09, and then went back to those investors for additional capital, helped do an add-on in, 10, 11, 12, they're just nowhere to be found. And we're starting to see the first deals come back to us from lenders that have BDCs and other folks who backed independent sponsors and now aren't comfortable putting equity in, but just, are sort of need an infusion. So I think what you see the independent sponsors that are going to thrive through this time is finding a stable investor base that will support them through the volatility you're going to have over the next 4 or 6 quarters. When we're looking for folks who are bringing us deals, for us the key is there are 2 camps. We see independent sponsors who basically hopped into a broad process and have thrown a bid in or have come in or just sort of a price taker. And those are groups that we're not really working with. The folks that we've leaned in hard on and backed and underwritten a lot of diligence expenses on are those that have a more, call it nuanced or defined investment thesis about an area, where they've gone and created an opportunity and working with an operator or a company, and aren't just looking for somebody to back them through a formal process. I mean, we see hundreds or thousands of auction processes a year, and we're not participating in them, so we're not really going to help other people just go through that same process, given there's not a lot of value add there. And I think that's the key to a good relationship, is the independent sponsor has to bring something other than somebody else's teaser and an NDA.
Yeah, from our perspective, all of that is true. The only thing I would add to that comment, at least that's Centerfield driven, is that we typically ask, more so now than before, is to ask the independent sponsors to bring real capital. So real capital meaning outside of just rolling their fees in. And the reason is a couple of things, right? One, we're not through the downturn yet. We're just in the early innings of it. And the companies would perhaps need more dry powder than in normal times. So outside of Centerfield, either it's just Centerfield or another mezz equity shop coming in and co-partnering, co-sponsoring the deal with us, or it could be NCK Capital, for example, or another group, a family office, bringing capital alongside us. That will give us a lot more comfort, frankly, than just Centerfield being the sole equity and mezz investor in the deal. What I've learned, which is probably not a trend yet, but at least in the 2 or 3 deals we are looking at, the independent sponsors started with a smaller amount of capital, but on the back end, they said, well, Centerfield, can you reduce your equity capital because we are oversubscribed in the deal? So it seems very interesting to me where my guess is the public markets are overly volatile, and family offices and their relationships, the independent sponsor relationships, are willing to invest more in these privately held businesses. And the equity account for independent sponsors has seems to be becoming a little bit larger than at least it was 3 or 4 months ago.
Yeah, I think one of the realities in this environment is that we're going to do a little bit more work on the details and on unit economics and understanding price and volume. And, those are things that are fundamental that we always do. A lot of times, you might take a Q of E. In normal times, you would take a Q of E from March and say, okay, everything's fine. It's going to understand that the TTMs, next 12 months is going to look very much like the TTM. In this environment, we're spending a lot of time, with CFOs, with the COOs, understanding what the current trends are, and trying to make sure we peel back and understand what the lay of the land is, and just, has the business come back? How will it perform in a protracted Corona environment? That to me is the fundamental question for what we're looking at. Bringing more capital to the business is something that certainly helps. We're also very focused on liquidity right now, and again, in an uncertain environment, you need to have the liquidity to be able to survive a 30, 60, 90-day shutdown potentially, depending on what the business is. So I think that's another thing that in normal times, you want to run lean and be very efficient with your capital. In these times, it's reckless not to have the appropriate liquidity cushion. And then most of the time, I would say that's in terms of cash, as opposed to potentially revolving facilities. We have, we've heard in the market there's some lenders that have had difficulties funding revolvers. So that cash is king, and in this environment, it's very prudent to have a oversupply of cash compared to normal times.
Thank you. So now let's switch our lens to the independent sponsor. So Grant, from your perspective, what are you seeing, how the capital providers been behaving these days, and have you changed the way you approach them?
Yeah, great question, Lilies. We haven't seen a big change, and we feel very fortunate because of that. That may be something to do with how long we've been doing this for and the size we've gotten to. And so we've had long-term relationships with lots of different types of capital partners and worked on lots of different transactions with them over the years. And so we have a great relationship. I can call Faraz up and we can work just as effectively over Zoom and phone as we can in person. I'd say for newer independent sponsors who are still developing their capital partner relationships, they may see some headwinds over the next couple quarters. Without the ability to build those relationships on deals, it can be tough. We're also hearing some whispers from capital partners that their perspective on the independent sponsors they want to work with has changed. They're less likely to take a risk on a first-time independent sponsor, or maybe someone who has one company in their portfolio, because most capital partners who are invested with independent sponsors, really don't want to be the sponsor themselves, right? And so they need to make sure that their partner can really be the tip of the spear on value creation, regardless of what happens to the business economically. And so that bar has probably gotten a little higher for newer folks or folks with less companies in their portfolio. I would also expect to see family offices coming into the independent sponsor world with a little bit more aggressiveness now. For the last couple of years, some family offices love to invest in private equity. throughout the cycles, but there's a large percentage of them who are more opportunistic and kind of view the next 12 or 24 months as a really great time to be deploying capital in private equity and specifically the lower middle market. So I think it's probably a tale of two cities for folks who've been doing this for a while, have a proven track record. It's maybe sourcing capital is probably a little easier right now because of more interest by family offices. If you're a newer independent sponsor, smaller portfolio, maybe it's a little bit more difficult.
Well, that segued beautifully for my next question. From a capital provider's point of view, does it make any difference? What do you do when this independent sponsor come to you and say, "This is my first deal"? How would you approach that? I mean, how do you look at it? Maybe making a comment from the capital providers, from debt and equity side.
Yeah, for us, it's very difficult, Lily. So, we've been doing independent sponsor deals since 2002. And, independent sponsors have been called many different names, and the latest and greatest is independent sponsors, right? So, we've learned a lot over the years, over the last 20 years doing deals like these. In our investment overview, we have a whole section on independent sponsors, their track record, and their experience in the deal. To Derek's point, what are they bringing to the table in addition? So, if it's a first time deal and if they don't have any value or any angle they're bringing, it becomes a really steep hill for us to climb. Versus, if Grant calls us, they've been around for a long, long time. They have a track record. It's easier conversation to talk about their independent sponsor, and then we at Centerfield, our committee focuses more on the deal, versus the other way around, where if it's a first time independent sponsor, we are focused a lot on that independent sponsor before we get into the deal and the underwriting of the particular company. So it's very difficult. I think it's getting more difficult, and I think Grant's absolutely right that if you have not been doing this for a while, it is going to be fairly choppy waters. And I think my guess would be it's more likely for those independent sponsors to do deals with Boyne Capital and others who are more hands-on and who are more buyout focused kind of firms, versus a group like Centerfield where we are really leaning on the independent. So I don't know how Boyne does it, but for us at least, we lean on the independent sponsor to really run the day-to-day or run the weekly meetings, and the management team is effectively reporting into the independent sponsor, versus Centerfield, which is a capital provider, which is on the board.
What do you think, Derek and Tom?
Yeah, I think I think it always goes to the heart of how good the deal is. For us, is to Faraz's comment, we have half our team is operations and portfolio management driven. That's Adam Herman, my partner, and then a group of another 5 folks who just focus on supporting the portfolio companies that we've invested in and bring that as a resource to an independent sponsor who maybe doesn't have, like Grant, a portfolio of 5 companies to support their operations, and they're more dependent upon making the first deal happen or 1 or 2 deals happen. But I think it goes to the heart of some points touched on by all the other panelists, that as you're going through this challenging time, people are going to look to the future with a broader aperture around risk and what might happen, rather than just assuming projections will occur and things will continue to go up and to the right. And that's going to make people moderate in a different way. And the one comment I'd make, where someone like Grant will probably have more success with family offices, I would look for a lot of my own experience in the last downturn was that groups like family offices became very sort of risk averse, and because they looked at people having to underwrite, unless they are the individual who created the wealth that drove and created the family office, the people that worked for those folks were very apprehensive about making a decision and pulling a trigger during the downturn because of their aversion to the binary outcome of losing capital. So I think there'll be greater uncertainty, but for us, it's not so much about the vintage of the independent sponsor, it's the quality of the deal and what value they're bringing to it. But we're happy to work with first-time independent sponsors, so long as it's a deal that they're really adding value through.
Perhaps, Derek, you say that because you've been on the other side of the coin.
Yeah. It can be. I mean, it's not for the faint of heart, and there'll be, we can all appreciate when you have a small portfolio, and it's what funds your rent and employees, and you're essentially wildcatting on a quarter-to-quarter basis. You want to make sure that your partners aren't going to suddenly block your management fee or put you in a challenging place. We always took the approach of, rather than having one investor in a deal when we were starting out, our deals were all syndicated. For Raz's point, we brought the equity capital, and in a group that might have 10 to 30 investors, and spoke for the equity when we brought in someone like Centerfield to help fund, or Tom to fund at Comvest, the top part of the capital structure. And that gave us a pretty sound base, and an ability to manage through one investor deciding not to go forward on the next deal.
Tom?
Yeah, I agree that we're going to focus on the deal specifically, the business specifically. And to the extent that someone doesn't have a track record as an independent sponsor, isn't going to be throw that opportunity out for us. I'm assuming that sponsor is going to have relevant experience and have been a CEO or COO of a successful business, and that's why they're kind of moving into something. There's a logic to doing a deal, but yeah, absolutely, we would have no problem kind of backing someone from a first time perspective, provided it's a nice deal and they have the right type of experience. I think anytime you're a first time independent sponsor, it's going to be more challenging than not, than having that track record. But from our perspective, from Comvest's perspective, we would have no issue, backing a first time independent sponsor.
So I'm going to take a break for a minute here. We're going to start posting the survey questions, and the way it's going to work is we want the attendees to start responding to that survey, and we will close the survey in the next 10 minutes or so, and then we will announce the results. So stay tuned. And we have a question in here before I move on to the next one. The question here is, when partnering with an independent sponsor, what are current market terms the sponsor would receive in terms of fees, carry, and so forth? This is for everybody.
Lily, the question is, you're breaking up a little bit.
I know, I apologize, and I'm not sure what to do with it. Yeah, I'm not sure what to do with it.
You were asked. Yeah, go ahead.
When partnering with an independent sponsor, what are current market terms the sponsor would receive? Fee, carry, etc. I apologize. I don't know what else to do with my. Can you hear?
Yeah, we can hear just great. I think it's working out really well. I'm not so sure there's one answer to that question. I think the political answer would be it depends. But the template is, I think guidelines are more there now than they were 20 years ago, for example, right? Just carried interest or closing fees or percent of EBITDA, tiered structure in terms of the promote, closing fees. They're all there now. The parameters are there. So generally I would throw some, and Grant probably is better served here than I am to answer this question, but I would think, it's 1 to 3% of the closing fee, depending on the deal size, and maybe upwards of $500,000 to $1 million of closing fee. The management fee is a percent of EBITDA. So typically, depending on the sponsor, the funded sponsor, or the institutional capital coming in, they would share in the fees or not, and that can range from, I would again throwing out some ranges here, 3 to 6% of EBITDA, 3 to 7% of EBITDA. The promote release would be, tiered typically. So 10, 10, 15, 15, 20, 20. So 10% IRR for the institutional investor. Perhaps the independent sponsor gets a 10% carried interest with a catch up or no catch up, depending on the negotiations, and could go up to 15, 15, 20, 20. In some cases, there are super promotes, depending on the strength of the independent sponsor and what the value of the deal is. If it's overly undershot, and a really good purchase price with a pretty solid deal. So I'm not so sure if I'm answering your question, because there is no one answer here. It all depends on the type of independent sponsor we are backing.
Derek, do you have an answer? You want to chime in? And Tom?
Well, I guess it's really going to go back to, as Faraz says, it's just going to be around underwriting what the value of the deal is. I think independent sponsors are going to will be able to demand the value that they bring, and a bit like Grant, having the diversity of a portfolio and the ability to speak to success will strengthen their hand. But I think they, like we do with our investors in a fund, it's all about creating alignment of interest. We put a lot of our own skin in the game. We're really one of the largest investors in our own fund, and we look for our partners to do the same thing.
I only have one real comment on independent sponsor economics. I honestly don't ever think it's enough. In all seriousness, to Faraz's point, there's a pretty good market out there. We all kind of know where it is. There's a little bit of sanding here and there. But to Derek's point, it depends on the value you bring as an independent sponsor, and frankly, the quality of the opportunity. We've been fortunate on all of our transactions to have a lot more folks who want to invest with us than we have space to accommodate. And so, we've been able to have economics that make sense for us and make sense for our investors as well.
Right. And so, this.
I just add real quickly, I agree with everybody that it depends on the deal specifically. We have in the past provided 100% of the capital for a minority position because the person or the group bringing the deal had provided so much value and experience that made sense. So, it's been that to low double digits or single digits for someone bringing a deal that's not quite as relevant or valuable or what have you. But so it's really all over the map.
Okay.
And Louise, one comment, sorry to interrupt you. One comment which comes to mind is, I think you'll get into some recommendations perhaps, but my thought is, if it's the first time independent sponsor or pretty new independent sponsor, I'm not so sure you negotiate to the last penny, just because to get the deal to the finish line is more important than negotiating the last dollar on the economics, frankly. Because if you're successful and if you do 2 or 3, 4 deals, I think economics get better, right? Because there are more capital providers who gravitate towards that independent sponsor, which is similar with us, right? If we have a good track record, our LPs are coming to us to say, hey, or Centerfield, we'll invest dollars in you just because you have a pretty strong track record. So the methodology and the thought process is the same way with independent sponsors.
If I had any advice to independent sponsors in negotiating with investors on economics, I would always put relationship and fit first above everything else. These are long marriages, and if you don't feel like you're going to have fun working together for the next 5 years, that incremental little margin that someone that's not the right fit may give you is never a good idea.
Okay, so let's move on to the next thought here process. So the deal are taking longer and harder to get done. So what do we need to see before the deals go back to a normal timeline? Do you think there is a new normal? And if so, what that look like? Anybody?
Well, I'll take a crack at it. I think it's really just like prior downturns. It's just going to be greater certainty about the near term is what's going to change it. So, the things that make deals take longer is, people's apprehension and the risk aversion that comes up, whether it's the, Tom on the senior debt and a unitranche, or Faraz and coming in sub debt. You have more constituents where you have to provide a greater degree of certainty. So, in the near term, a calming or a decrease in cases and fatality, or an introduction of a vaccine and so forth, would be clear signs where people can say they can start, worrying less about the pandemic and the impact on the economics. Personally, my view is I think you'll also see ongoing economic volatility coming out of this. So I think you should prepare that, you're going to have to roll up your sleeves, and getting deals done will be harder for the next year or 2 years, depending on the pace of the recovery. People get quicker and look past issues, the more certain they are in the outcome of the future. It's that classic fear, greed, the pendulum. And right now, people are more fearful.
Yeah, I agree. I think that's a great point. Getting longer, I think people want more real-time information. Last month, last week, flash numbers. So I think that's something that's been, clearly introduced into the equation. I think the other part to consider, where we are now is just the logistics of getting a QOV provider, to go on site. I personally won't invest in a healthcare company unless I've been in the facilities myself. So those are challenges and things that we're going to have to figure out how to overcome. We've got an opportunity that we're looking at in California. We happen to have a California office, so we're saying, okay, let's bring him into the deal team and have him go to be able to do a site visit. So I think those are things that are real world issues that come up while we're in this type of situation. I guess we'll see if the world starts to open up eventually, but it seems like we're going to have that for at least the rest of the year, and potentially for a full 12 months or so longer.
It's going to be a while before deals go back to the pace they were at before in terms of closing. I mean, until we can all get on airplanes freely, it's just going to make it tough. I don't know about my fellow panelists, but we've done a couple Zoom management meetings, and they're fine. They're not fantastic. It's hard to build a relationship over a video conference call, but they're a good way to move forward given everyone's limited travel availability today. We got close to signing an LOI on a new platform in the last 30 days. Unfortunately, the seller kind of got some COVID cold feet due to some personal issues, so that didn't move forward. But in anticipation of getting that signed, we were identifying QE providers that had a local presence, so that they didn't have to travel on airplanes to get there or could drive to the company. When we were thinking about lenders, we were thinking about folks who were in the neighborhood who could also get out to see the company in an easier way. I think we're all going to have to get creative over the next couple quarters, and hopefully some of these vaccines that are in the phase 3 trials get some traction in Q4 and Q1 of 2021.
Okay. So what about broken deal costs? Has it changed pre-COVID and current situation? You want to comment about that? Has the risk shifted, and if so, which shifted to whom? More on the capital providers or the independent sponsor?
Yeah, for us, the way we are thinking through this is let's do a lot of upfront diligence before we sign up the deal. And same, I think we are advising the same to our independent sponsor relationships is, hey, let's not jump into a deal where we don't have anything beyond March numbers, or if there's some issues, let's dig a lot deeper now and then get into exclusivity. In terms of deal cost, I mean, again, it's all over the place depending on what kind of independent sponsor they are, what kind of capital they're bringing to the table. They have a strong family office relationship, if that changes things. So again, not one answer there, Lily. For us, nothing has changed from that perspective outside of just doing a lot more diligence up front before inking a deal or issuing a term sheet.
So no change the way you handle the broken deal costs?
No change.
Okay. Anyone else want to comment on that?
I'd add one thought. Like Faraz, we're doing a lot more work early in the process, and our work is really focused on looking at the most recent period's performance and really trying to understand if that performance has impacted positively by the pandemic. We recently looked at a business in the continuing education space, and they were trying to value the business off of an annualized 2020 number. They've been having a great year, and we made the point, hey, if you're sitting at home not doing a whole lot, knocking out your CE credits online is probably a great way to use some time. And you know, at the end of the day, other folks value the business based on those metrics, and you know, we just don't think that would have been a really a good indication of the future. It was really taking a small period where they'd had some positive results due to the pandemic and annualizing them. So we were also looking at other business today where they've done well over Q2, but we're trying to understand whether that will be a long-term trend, or is there something that has kind of hidden what could be some future weakness? So I think all of the investors out there, including my fellow panelists, we all don't want to make an investment and then wake up 2 months later to you know, softening from the pandemic that we didn't expect.
Yeah, and I would add one thing. This is, I guess, a point where we come into just philosophically, I think, how independent sponsors have evolved in sort of the heat of, or the frothy part of the market in the last few years versus where it was when we started, and probably others on the panel started. And that was, we bore all the cost of the deal up front until we went to our investors and raised the capital, which gave us the ability and the power to have the pricing and the control that we wanted. And I think it'll be interesting to see where a lot of you know, sort of first-time independent sponsors, or folks who've done a deal or two, are looking more for, you know, someone else to bear the risk on the broken deal expenses, and for them to have all the upside. And it goes a bit to, I think Faraz made the comment about wanting people to come with more capital, or Tom had made that point as well. I think we're looking for people to, if you want to have, you know, all the upside, you have to really put something at risk day one to be there to justify and get a part of that. And we understand that we just won't see eye to eye with everybody on that, but having done that ourselves for the better part of a decade, we feel like we have this, you know, some philosophical and practical standing to say, hey, this is what's fair. And we'll see how the market takes it.
Tom, do you want to comment?
I think I don't really have much to add. I think my panelists did a great job. There is more risk to getting deals done today because there's much more volatility in the overall market, whether it's consumer demand, whether it's the financial markets. So that's the fees and breakup fees and expenses is going to continue to be a focus, as it should be.
Great. So with all these different components that we've been discussing, I think it's time for us to show the result of this poll for the question. So can we show that, please? Here we go. So what do you think of this? 60% of the poll says that the independent sponsor industry will grow. And in the current, number two, in current circumstances, how likely are capital providers to support independent sponsor? More likely, and look at that, 44% says less likely. And number three, it says in current circumstances, how likely are investment banker to show deal with independent sponsor? 30 and 40%. And
Well, number two and number three are not necessarily consistent with number one.
Well, we'll go and visit this question, and I'd like to get your comment on that. And number four, have we switched from seller to a buyer market? Still 56% is saying no. So what do you think, guys? You want to comment about number one? Anybody want to comment about number one? 60% think it's going to grow. Do you agree, disagree?
I'll jump in there, Lily. I actually think it's going to shrink. I think the available capital to newer independent sponsors is going to really shrink. And so that'll cause the overall independent sponsor industry to shrink. I also think bankers are going to do more diligence on independent sponsors and hold groups to different standards based on their track record and experience. So there's just been an explosion of independent sponsors over the last 2 or 3 years. And I think a lot of there'll be a thinning of the herd, right? There are a lot of folks out there who have never completed a transaction. They will probably fall out. There are folks out there who have one company in their portfolio. If that company's having any kind of challenges and their management fee has been accrued or turned off, they will have a tough time moving forward. I definitely think it will be there'll be a thinning of the independent sponsor herd going forward.
Yeah, good.
So Grant, I think there'll be that will be the case over the sort of near term. I think longer term the trends are going to go back to supporting independent sponsors. I think the model makes sense. I don't know what that time period will be, but yeah, during this time of distress and disruption and COVID, I think people will be a little bit more cautious. But longer term, I think there'll be growth in the independent sponsors for sure.
And Tom, that's a good point. I agree with that.
Yeah, the two things which come to mind is one, the supply of capital. So the supply of capital is still there. And what I've seen, and maybe this is also not a trend yet, but what I've seen is buyout groups who didn't work with independent sponsors before, they're still looking for unique ways to drum up deal flow. And they're starting to look at minority equity or some kind of a nuance within their equity structures, which is different from their traditional majority control, just the only institutional investor. So there could be an opportunity, again, because of the supply of capital. There's tremendous amounts of capital overhang out there. So it is looking for it to be deployed. The capital is looking for being deployed in deals, prospective deals. The other trend which I'm seeing is, I think there will be more sellers. And especially individuals and business owners and entrepreneurs who went through this great recession. I think my guess would be that they probably don't want to wait another 4 or 5 years for financial stability to happen. I think they're potentially at a point where they're saying, well, I don't have the time frame in mind. I don't have the patience in mind. Let me go exit the business before I have to go through a turnaround situation. So my guess is there will be a supply of deals and there's a supply of capital. So there could be, because of that, perhaps the surveys pointing to the fact that there could be more independent sponsor deals and more independent sponsors.
I would say I tend to agree with Grant's observation about the near term. I think there'll be maybe a lot of churn in the independent sponsor market over the coming year or two. And if you think, there'll be maybe more independent sponsors being attempted to get into the game as you see traditional private equity firms reduce staff or other groups of capital providers that have traditionally been the prior home of new independent sponsors. That'll create more people out there that are trying to do something. But at the same time, it's not a model that you can operate unsuccessfully for an extended period of time. I mean, there's no management fee, there's no income coming behind it. And so, if it is a tough market for the next year or 2 years, I think people will realize that it's not quite as easy as, all the articles and buyouts or private equity analysts would lead you to believe about the growth of the independent sponsor, and can be pretty discouraging, and will sort of thin people out on that. And I think that's, what you're going to see as people go forward over the near term. The second part of the question is going to, will they show more deals? I know when we're exiting our companies, we're trying to minimize as many risk points in a sale process as we can. And when an investment banker will come and say, well, gosh, here's an independent sponsor we want to show the deal to, we're like, unless somebody comes with committed capital in hand, we view that as just a disqualifying event. And it's almost a bit like a perverse incentive or messaging where they say, well, they're the highest bidder here. Like, well, they have the highest standard to meet to show they actually have the capital to do it. So it'll be interesting. It may not be the greatest thing for them to see, more competitive auction processes, because, they spend a lot of time on it, but I think they're tougher deals to get done.
Any other thoughts? What about what do you think about question number 2? Is in the current circumstances, how likely are capital providers to support independent sponsor? What do you think of that answer? 18% more likely, 44% less likely, and no change, about 38%.
I think from a Comvest specifically perspective, that's not the case for us. I'll tell you that much. We're probably, no change or more likely. From the overall market perspective, I agree with this. Actually, I think that there are certain lenders or banks, that just really have that private equity focus, and that don't quite value independent sponsors quite as much. So I think from an overall market, it will be more challenging for an independent sponsor to get financing.
Anyone else wants to comment on that? No? Let's look at number 3. In current circumstances, how likely investment bankers to show deal to independent sponsor? 40% say likely, and then 33 more likely, and no change in 27%. What do you think of that?
We do it somewhat similar to how Boyne does it, right? Whenever we're on the exit on the other side, the certainty to close is super important. And, oftentimes, depending on which independent sponsors, because the community and the universe of independent sponsors is increasing, has increased rapidly over the years, we would see some outliers in the matrix where perhaps it's 2 to 3 turns, maybe 2 turns higher purchase price multiple, but we take a step back and say, what's the certainty to close, because they have to run their own process again. So it's a 2-step process, right? So from the investment banking perspective, I think it will be probably more of the same. Is they'll show deals to independent sponsors who have a high likelihood of certainty to close and have a reputation of closing deals, and they'll treat them just as independent. My guess is investment banks will treat them just like they have treated them before. If they're first and second time independent sponsors and don't have much of a track record to get a deal closed, don't have the relationships already with capital providers, I think independent investment banks will shy away from showing them deals just like they did pre-COVID.
I think this is a complicated question, Lilies. From my perspective, I think good independent sponsors out there, to Derek's point, to Faraz's point, if we're bidding in a process on a really clean company with 5 to 10 million or 15 million of EBITDA, it's pretty tough to compete with the funds out there. I think what makes good independent sponsors good is our ability to find interesting investment opportunities that probably have a story. And that story's making them a little bit less attractive to traditional funded sponsors. And what makes the good guys good and the bad guys bad is knowing how to interpret that story, right? Where is that story really an opportunity for value creation, or really where that story is a risk? And based on that, going into the kind of post-pandemic era where companies are going to have some real choppy earnings, the good independent sponsors are probably going to do a good job getting in there and really figuring out whether that business is going to rebound and how quickly and can be successful. It's the time to figure that out versus the funded guys who probably don't have the time to get that deep on the opportunity that may on the surface not look very attractive.
Okay, so I'm watching the clock. You got with the last 2 minutes here. I want to address number 4, have the market switch from seller to buyer market. And all I need from you guys is an opinion, yes or no. And then unfortunately we ran out of time to answer more questions or be talking about something else. What do you think?
Not yet.
Okay.
I'd say yes, but I agree with Faraz's direction.
Tom?
I would say generally not yet. It depends on the industry. There's been some segments that maybe have switched.
All right.
I'm gonna go with not yet.
Wow, pretty unanimous, not yet. So the pricing is still pretty high?
For quality companies.
Yes.
Yeah, in spite of the market. Well, the dry powder have still not evaporated yet. It's still there. It's just waiting for the moment to be deployed, right?
That's
Well, with
correct.
that said, I need to close this. I appreciate it so much. And most of the people I see participants stayed all the way. I hope that's a good sign. I hope you have enjoyed it. And I truly appreciate all of the panelists here for coming and carving out your valuable time to share your knowledge. And again, thank you so much. And I appreciate all the attendees as well.
Thanks,
Bye now.
Lily.
Thank you.
Bye.
Thanks, Lilies.